Things. First, I want to talk about the midterm. So, the midterm is going to be on Monday, and what's going to happen is you're going to take the exam during the time that you're registered for this class on ELMS. Right? So right now, if I'm speaking to you, you should be in this class based on this is the 2 p.m. class, which means the exam you will take is between 2 p.m. and 3:30 p.m. Let's say you were in the 3:30 class and happen to be in the room right now. You won't be able to take the exam at 2 p.m. You would have to take the exam at 3:30. So again, the 11 a.m. section, take section 101 is 11. Section 201, if you're registered for that, you have to take it at 12:30. Section 301, 2 p.m. Section 401, 3:30 p.m. So what will happen is on Monday, when you go to assignments, you will see down here under the assignments, midterm 1 will be replaced by midterm 1, section 101, 11 a.m. Midterm 1, section 201, 12:30 p.m. That is a link you will click on. That link will only be available during your section time. So if your section time is 2 o'clock, at 3:30 that link goes away. You won't be able to submit. You'll get a 0 for the exam. So you must take it and submit it during that 90-minute period of time. Okay. The link will be available 5 minutes before your section starts. So if you're in the 2 p.m. section, it'll actually show up at 1:55, and then it will disappear at 3:30. It is your responsibility to upload your Excel file and submit your solution by that time. There will be a 5th link. It will be called Alternative Midterm 1 Exam. There are people with special circumstances that have been pre-approved, you being one of them, that have the ability to take it at a different time. That alternative exam link will be available all day Monday. Those people who have been pre-approved, either through DSS or through another approval, can take the alternative exam. That one will be open all day, but the only people that will be graded that take the alternative exam will be the ones that have pre-approval. So if you take the alternative exam by mistake, you're going to get a 0. Okay? So you can't take the alternative exam unless you have it, because that one does not cut off after 90 minutes, because the people there have exceptions on when they will take it. So if your DSS, for example, you have 3 hours to take it, well then, and they have a class right after this, I can't just say take it, stop, and take it again, because you need a full 3 hours. So they can take it any time during the day. Or somebody else who has an exception, again, because of other classes, they can take it, or whatever their exception is, sometime during that Monday period, subject to the 90-minute rule. But nonetheless, they have flexibility on when they take it, but that was pre-approved. So if you're not pre-approved, take it based on the one that has your section number in it during that 90-minute period of time. Questions about that? Hopefully pretty straightforward. Yes, sir. You will not need Bloomberg. Midterm 1 is a repeat of homework 5. It literally is just an economic statement conversion in Excel. There's no essay, there's no write-up. You just convert and upload within 90 minutes in Excel file. Yes.
Is it a lockdown browser?
I don't think there's a lockdown browser, no.
And also, like, you're not given, like, you know how you broke them up into the buckets, like 1, 2, 3, 4?
I will give you the 1, 2, 3, 4s.
Oh, okay.
And we're going to go over the solution for that in just a minute, but I'm just kind of structurally telling you about the logistics for midterm 1. Okay? Yes, sir.
And then do we come to class to do it, or is
So here's what I'm going to do, and I'm going to give you my fire and fury speech here in just a second. All right? Shouldn't apply to the very majority of you. But what I have tended to find historically is that people in my 11 a.m. section are not as smart as people in my 3:30 section. I can never explain it, because when they take the midterm at the 11 a.m. section, they do poorly. And by 3:30, everybody gets an almost perfect score. So I find it hard to believe the distribution of students is really smart people take it at 3:30 and really dumb people take it at 11. I just don't think that's right. So obviously something's going on, and I'm not going to react kindly to that. So here's the deal. I'm going to let you take it, not in this class, anywhere that you can have a browser, right, and access to the internet, access to ELMS, and a computer with Excel. Because it's literally download the file, convert it, upload it. You don't need Bloomberg. That's the entire midterm. You have to take it during your exam section. However, if, and this is now being recorded and placed on YouTube for the Honor Council, that I will show them as an Exhibit 1 in your indictment for honor code violation, is that the only sanction I will accept for cheating on this midterm exam is an XF. Okay, that is it. which in case you don't know, that means dishonorable fail, and you won't get a diploma and no employer will ever hire you. Okay, so basically don't do it. Right, so that's my implied stick to the honor council. It's not worth destroying your entire life over a very easy exam. Right, so basically don't do it. And here's what I mean. This is what you're not allowed to do. This is an individual exam. You can't use WeChat. Okay, you can't use Snapchat. You can't use Facebook. You can't be sitting around a table with a bunch of other people taking the exam simultaneously saying, hey, can I figure out how to do this? We've caught people doing that before. I will intentionally put in markers. And if you have the same incorrect answer as somebody else, you're going in front of the honor council. All right, and I'm just going to be vicious. You're going to hate me. I don't care. All right, but I'm just telling you, there are going to be things I'm going to do that will make it obvious that you were collaborating to the best of my ability. I will also tell you the exam is different by section. So if you take the exam in your section and you happen to take and submit the wrong exam, that's going to be really, really bad for you. Okay, so just saying, don't do it. It's not worth it. That being said, it is open book. It is open notes. It is open computer, subject to no collaboration, and the new University Honor Council, you can't look up past exams, right? But if you wanted to have Homework 5 solution next to you while you're trying to do this, I don't have a problem with that, okay? What I do have a problem is if you have somebody else sitting next to you and you're both working at the same, that is a blatant honor code violation. So you have to do it yourself. That's what's going to matter as you go through this exam. So I'll get off the soapbox, but I just want to make it clear and unambiguous that I'm going to give you the benefit of the doubt, okay, with a short leash, okay? And the point is, you can take it wherever you want. You want to take it in this room will be empty. You want to take it in the library, you want to take it at Starbucks, you want to take it in your dorm, it's up to you, but you have to take it during the class time you're registered for, unless you have a pre-approval allowing you to take that alternative exam. But as I said, don't take the alternative exam unless you have a pre-approval, right? If you have technical difficulties, timestamps matter. I'll be very specific. So let's say you have a dog, and the dog hears somebody knock at your door, and the dog goes flying across the room at 3:29 to bark and see who's at the door, and accidentally knocks the cord of power out of the wall, and your computer dies, then I expect an email 2 minutes later, as soon as that computer reboots, with an attached file saying, the dog pulled the power cord, I'm really sorry I missed the deadline, here is my file, timestamp 3:31. If you send me an email at 4:15, I don't care what the dog did, I'm giving you a 0. So what I'm telling you is if you have a technical difficulty, which inevitably somebody will, we're just dealing with technology, the timestamp matters. Do not send an email without an attachment. If you send an email saying the dog pulled my power cord and I didn't attach a file, then I'm not going to have any mercy for you and you're going to get a 0 on the exam. So my next recommendation, you've heard of autosave. Take advantage of that. Or be obsessive. Save, save, save as you go along. So that if you do lose power, you do not wipe out your whole exam and at least submit the part. That's the next thing. If it's 3:29 and you're not finished, submit what you got. Because it's better to get partial credit than no credit. Okay? And I'm just saying that part of the exam, and this part of the grade, is getting it right, and the other part is doing it under time pressure. Okay? So the time pressure is part of your grade. So removing the time pressure is a completely different exam. So you're not getting an unlimited amount of time. And just, again, what's key, and this is key to the entire semester, and I just want to be very transparent with you because I want you to understand the rules, is that what I do for him, I do for 159 other students consistently. And what I would not do for him is anything different than I would do for any one of you. And that's just the way that I believe I need to be fair to you as an instructor. Now, some of you hate that fairness, and you've already experienced it this semester, but I will at least try and be replicable here. So again, I will be as fair as I can, so as long as you follow the rules. And what the rules saying is timestamps really will matter. So if something goes wrong, just send it in as quickly as possible, whatever you got. And we'll try and be as discerning about this. Here's the other thing I'll say, which is if you have, somebody asks, like, do I have to show my work on the numbers that I submit? And technically the answer is no, that if you get matching statements and you don't show all your work, we might be a little suspicious, but we'll give you credit. But here's the thing. If you have anything wrong and we can't see your work, there's no chance that we will be able to change your grade with a mistake. Like let's say you have temporary dyslexia and you transpose a number. Okay, so instead of 113, you type in 131. just by accident. If all we see is 131 and you tell us you transpose the wrong number, you're getting a 0. Right? If you can show us all the numbers above that that would add up to the 113, and then you see that we actually transpose it, then I might have a little tiny bit of love in my heart for you for the very first time, and I might actually tell the TA to give you credit for that. But the only way we're going to be able to do that is if we see your work. So again, it's not our job to go back and check everything that you do in the work to make sure you get the numbers, but if a mistake is happening and you don't do the work, it's hard for us to justify giving you credit when you said you accidentally meant to type in the other number, because we otherwise can't validate that. So it is in your best interest to do that as much as possible. By the way, showing your work shows things balance, gives you more comfort yourself than taking too many shortcuts when you do the analysis. But again, you're adults. If you can do it really quickly and you know how to do this stuff, I'm not going to make you do work just to do work. But the flip side is it will help you potentially when you appeal a grade. Yes?
Wait, so there's a written analysis in addition to...
No, not for this exam.
So, but like in showing our work in this Excel file, would just be like formulas. Right?
Well, here's an example. If I go to, just jumping ahead, if I go to the solution for homework 5 and I am on, where'd it go? Well, there was a solution for homework 5. If I go to the homework 5 solution and I'm on the CFI and basically I see gross investment of negative 273 is the right answer. If you typed in negative 237 and you accidentally typed in the wrong number, and that's all I see, gross investment negative 237 and nothing above it, there's no chance I can give you credit for it, even if I know you transposed the number, because how do I know you really transposed the number and didn't get the numbers above it wrong? Versus if I see all the numbers above and I do a sum and they add up to 273 and you have 237 in here, well, then I know that you accidentally made a mistake. Right? And I'm not trying to penalize you for accidental mistakes, but I am trying to penalize you for theory. And I'll give you another example. If in economic profit, I say use beginning of year, that means this divided by that, current divided by previous. If you do current divided by current, even though in hindsight it looks like a stupid error, you're like, oh, I made a stupid error. At the time, you made, as far as I'm concerned, a conceptual error because you didn't understand that you're supposed to use last year's number when you do beginning of year. So again, if I don't see your work, there's no chance that I'm ever going to give you credit for having the wrong ROIC, right? If I see a typo here where it's this divided by this, probably still not going to give you credit. So some areas I'll be able to give you, some areas I won't. But again, it's going to be honest, innocent mistakes, not conceptual mistakes. Because conceptual mistakes look real obvious in hindsight. But that's the point of exams, right? And again, it's just fairness because I want to be fair to everybody here. And more importantly, I want to be fair to the 11 o'clock section. Because as I said, I think they're just as smart as anybody in the other later sections, and I don't want to be them at a disadvantage just because they happen to sign up for an earlier section. So there's just no reason at this point in your career to be doing that stuff. So again, this is not a team exam, this is an individual exam. All right, so let's go back. So take the exam, take the alternative exam, submit by Monday. Tomorrow the TAs are having office hours for 3 hours total. If you have questions about any of this stuff, work with them. But the entire exam is literally going to be download an Excel file, convert the Excel file, 4 tabs, balancing statements, submit the Excel file, done. Do that in 90 minutes. Questions about Monday? Yes, sir. They're on the syllabus, but I think it's generally from about 12-ish to about 4-ish. Yes?
If we want to practice our time, do you have any practice problems?
Great question. So what I also did is if you go to the file section, you will see an exam called the practice midterm. And what the practice midterm is literally that. It's a midterm from a few semesters ago. So it's an actual midterm exam. And so basically it's an exam and it's a solution. So if you want to practice, it's a good way to try to practice. My recommendation is if you're practicing is don't look at the solution first. Like try and do it without looking at the solution. But you have the one you just did, and then you also have the practice midterm, you have the example in the book, and that's really all the exam is going to be about. I can also tell you that the columns and rows will be different by section. So just as a hint, that's one of the ways that I will catch you. Okay, so there will be items that are listed 1, 2, 3, and 4 that are in your section that may or may not be in a different section. And if I see them in your section and they weren't on your section's exam, that's really bad for you. As I said, considering that those links go away at the end of the section time, there's no way you end up with that file, right? And if you make mistakes with stuff like that, because numbers are changing, really, really bad for you. Yes?
Is everything worth 25 points, like TI?
Well, it's worth a quarter. It's worth 7.5 points. And across the four, it's actually spread out across the four. It's about a quarter each, yeah, for each one of the statements. Okay. To be honest with you, I could actually just ask for one number. Like if I asked for your 2017 CFI in this assignment, that's the only thing I needed to know, because you wouldn't have gotten the other statements to balance if you didn't get that number right. But rather than putting the entire exam on one number, I'm giving you some partial credit by doing the statements along the way, because what I'm about to guess is that most of you did okay on TII and TFI. The place that you struggled was CFI. And that's what we're going to try and cover in class here today. Okay? But that's the exam. Okay, so that's now what I want to do is I want to, and the practice midterm is there, so let's talk about homework 5. So homework 5 and the solution. Okay, so again, for the exam, the labels will also be there. I'm not going to try and trick you. You're not used to all of the accounting, so therefore I'm going to tell you the 1, 2, 3s, and 4s. So that should make it a little bit easier when you go through the process again. One of the things that came up in the earlier sections that you may or may not be struggling with, but I thought I would give you as a rule of thumb, is when it comes to TII, what you tax affect and what you do not tax affect. All right? I just assumed it was obvious, but maybe it wasn't. But generally, if on an income statement, there's a line item before income before tax, so up here, or profit before tax, you have to tax affect it. If there's a line item after income before tax, or after the tax has been taken out, you don't have to tax affect it. So for example, if I have non-operating income, I got to tax affect it to get the after-tax non-operating income. If I look at minority interest has already been tax impacted, so I don't have to double tax impact it, because that would be a mistake. Okay, so again, just as a rule of thumb, I'm not going to throw a curveball at you on the midterm. Basically, if it's above taxes on income, you'll have to tax affect it. If it's below taxes on income, it would already be after tax. Okay. Now again, I'm not saying some squirrely accountant somewhere might not do something weird in the real world, but I'm not going to do that to you on the exam. Okay. All right. So let's talk about the statements. It doesn't matter whether you do TFI or TII first. Okay. Those two statements have to both be done before you do CFI. So I like to do TFI just because it's the easiest of the statements, but as far as I'm concerned. But nonetheless, here's TFI. So again, you're going to notice something different in my solution than what we did this last week. It's not necessary for this homework. It's not necessary for the exam, but there's an important step towards the valuation models we're going to build. So generally, for invested capital, which we will call operating invested capital, and I will be lazy because I might call it invested capital, but going forward in this class, if I use the word invested capital, unless I say otherwise, I'm talking about operating invested capital. So to calculate that, I take all of my asset ones, I take all of my liability ones, and I net them together. And that gets me my operating invested capital, which is row 14 for those 3 years. Okay. Now, there will probably be 3 years, there might be 4 years on your midterm. And the point is, it doesn't really matter how many years are, because it's just cutting and pasting. But there will be at least 2 years. Why will there be 2 years? Why must they give you 2 years in the midterm? Yeah. Exactly, because cash flow is about changes in the balance sheet. So therefore, I have to give you at least 2 years of the exam to do a CFI. So there'll be at least 2 years, but likely 3 or 4. Right? And more years is just really to intimidate you. All right? There's actually no other reason, because once you do it once and you copy and paste, it works across all the columns. All right? But here's the deal. So what I also did here is I started breaking the invested capital into operating working capital and long-term capital. So operating working capital were my current ones that are assets and my current ones that are liabilities netted together. It's called operating working capital. And then I took my long-term assets, PPD and goodwill ones, netted them against my long-term liability ones. That would be my long-term capital. Add the two together, invested capital. As I said, you don't have to do this for the exam. You could have just taken all the current and long-term ones and netted them. But here's the point. The reason I'm doing this is when we actually do the valuation, which is coming next, we will want to forecast working capital separately than PP&E, right? So whereas if we just forecast operating invested capital as one blob, then it's not as representative of what's going on with the firm. So I'm going to start putting it into more of the buckets that you'll see later in the semester, but that is not a necessary step for this midterm exam. So if you just put all of your assets and all of your liabilities, listed them, netted them, and got invested capital, that is acceptable for the midterm exam. Okay. So you then take your non-operating assets, all your twos, and your non-operating liabilities. In this case, it was the other long-term non-operating liabilities. You net them, and that would be your long-term, or your non-operating capital. You add the two together, you get your TFI. I was being lazy, I didn't put a line item for that. But basically, you can see the 3725, 3702, and 4090. And then same thing, take all your threes, take all your fours, add them up, and then hopefully get balancing TFIs. The way you're going to be graded, it's very simple because you may not get your grade before Monday. It's basically when the TAs open this, they're going to check these two numbers, and then they're going to check that it balances. If it doesn't balance, even if these numbers are right, you get a 0 for the tab. Okay? So if they match and they balance, you get a half a point for the tab. That's the way the grading will work. Similar on the midterm. So there's two parts to this. Right answers and balance. Because those are the two things that matter. By the way, this is why labels help. Because notice all my groupings of 4s and 3s and 2s and 1s are together. It's more likely that I'll put things in the right place. Okay. So again, the labeling helps us kind of make sure we get the groupings right across the 4 sections. Because that's where the common errors are. But nonetheless, this was TFI. It's the most straightforward one. Questions about TFI? Yes, sir. Oh. All right. So there's 2 accounts that popped up, by the way, on the accounting side that people in the last class were not as familiar with, that you may not be familiar with as well. Again, it doesn't really matter because if you know it's an asset, you're adding it. If you know it's a liability, you're subtracting it. But nonetheless, one was called minority interest. This is minority interest on the balance sheet. And the other was treasury stock. But I want to talk about minority interest for a second. I don't like the title that accountants did because I think it's actually kind of confusing. I think they could have named it better. But here's the way it works. We talked about last week, equity investment. I buy a non-controlling stake in a company. That is called an equity investment. It's an asset on my balance sheet. From the perspective of the other company, that shows up as a liability and equity that they owe to me. That's called minority interest. So my equity investment is the other company's minority interest. And the idea is they are a minority shareholder as opposed to a common shareholder. And the general perspective is they get a percentage of the earnings that were absorbed, but they don't get a percentage of the entire business. See, common shareholders get the whole business. Minority shareholders only get a percentage of the business that was absorbed by the other company that they control, that they then pay out just that portion of the income to me. Okay, so if you ever see minority interest on a balance sheet, it just represents exactly that. A interest in a company that we have absorbed, that we owe to another company, that they don't control what we do. Okay, so it's their equity investment. By the way, what makes it trickier is on the income statement, it's also called a minority interest. And what the minority interest represents on the income statement is a distribution to those minority shareholders. So for practical purposes, the accountants of the government say, look, if I control a company, I'd actually rather have the company pay the taxes rather than a bunch of people pay the taxes. So when I absorb another company's minority share, I actually pay the taxes on their behalf as the company. Then I give them their share of the profits after the taxes have been paid. That's why minority interest is listed after tax, because it's easier for that company to pay the taxes than the government to start tracking down multiple companies for minority interest to go find out what your share is. So long story short, the minority interest on the income statement is the dividend that's actually paid to the minority shareholder. Okay? The minority interest on the balance sheet is the total amount of the balance sheet investment that is owed to the minority shareholder. All right? It's currently classified as equity. FASB is actually reevaluating it now, is reading, to decide whether to classify it as a liability. Because technically it's a hybrid, because it's equity, but it's a liability to another shareholder. So it's not my shareholder. So it's a quasi, it sits on the line between debt and equity, or liability and equity in the real world. So I think FASB is actually talking about reclassifying as a liability. But it doesn't really matter. For our purposes, it's a 3 or 4. It's a financing and it's a funds flow for the business. So that's why you see TFI. This minority interest represents the stake. The stake didn't change, so it didn't matter. It will probably change in your midterm. The other one is Treasury Stock. Treasury Stock occurs basically when the company repurchases its shares. That's where Treasury Stock comes into play. So when a company initially issues the shares, they issue them at common stock at par value plus paid-in capital. And then when the company buys back its stock, it pays market value. So it's issued at book value and it's repurchased at market value. For most public companies, the market value is far higher than the book value. So as companies buy back their stock, the Treasury Stock, as a contra account to equity, represents the market value of the shares repurchased. I work with companies like Lockheed Martin, which have actually bought back so much shares at such a high price, they've been doing well, that they actually can have negative equity, even though they have more shares of stock, because they bought back about a quarter of their shares, but it's at such a high price, it actually can wipe out the book value of the equity. Okay, so you can actually see Treasury Stock overwhelming the common stocks, just the way the accountants work. But the point is, this is market value. If the company were to reissue the Treasury Stock, it's different than issuing new shares. It just resells the shares back to the public that it had purchased previously. But here's the other key to Treasury Stock. The company doesn't get to vote on its own Treasury Stock. So when a company buys back its stock, it doesn't vote on the shares that it repurchased. It just basically takes them out of circulation. And then the existing shareholders, the remaining shareholders, just get a bigger share of a smaller pie. Okay? And that's really where Treasury Stock comes into play. But the point is, these big increases in negative Treasury Stock represent stock buybacks. That'll be important when you get to your CFI. All right, questions about TFI? Okay, TII, again, 4 sections. First section was operating, so we look at no plat. That is our EBIT after tax, okay, or operating income after tax, typically, and that would get us our no plat. Then we look at the non-operating items. The 2 on there were interest income and non-operating income. We tax affect those to get our after-tax interest income and our after-tax non-operating income. If we add the after-tax interest income and non-operating income to the no plat, we get our TII. Here's something that's a nuance you may or may not notice. Interest expense is a 3. Interest income is a 2. Why is interest income a 2? Where did interest income come from? Yeah.
Interest in your excess cash.
Exactly. And so this is what I mean by shortcuts people take in the real world. What we're clearly seeing here is that I have debt, I pay interest on the debt, that's my interest expense. I have cash sitting in a bank, I make a profit on that. It's not really what I do, but I get a profit. It's non-operating profit. Here's what people do in the real world. Net interest income. They'll net the 2 together. And here's my net interest expense. Net interest expense. They'll net the 2 together, the interest income and the interest expense, call it net interest expense. What they're doing is they're mixing operating and financing flows. It's a shortcut. People will use it, but then it's not truly a net debt when they start doing their net debt calculation because they're mixing operating and non-operating together. I'm not saying it's right or wrong. It's just, this is what I mean by, as you start going through this in the actual way it ties to Miller, you'll start to see where people have taken shortcuts. And there's an example of a real world shortcut because technically interest income is not a financing flow. Okay, it actually comes from non-operating activities. Long story short, that's your TII. Questions about this side of the TII statement? Well, it was pretty straightforward. All right, trickier part was on the other side. Again, both for TII and CFI, again, the statement is set up so that if you have income, then on the financing or funds flow side, when you pay out or distribute that income, 2 sides have to balance. So positive income, positive payouts. If you lose money, negative income, you need to finance. So negative income, negative financing inflows. So on the financing fund flow side of the statement, the bottom half of the statement, any payment to investors is a positive number. Any inflow from the investor is a negative number. So for after-tax interest expense, that is a positive number because I'm giving the money to my investors, right? The 37.8, 43.4, and the 53.6, and the 56. For the minority interest, that is essentially a dividend that I'm paying to my minority shareholders. The only quirk to that is I've already paid the taxes, so I don't tax affect that. I add that to my net income, which is the end of my income statement. Dividends are not part of net income. So therefore, add it all together, the 247.8 matches the 247.8. So again, I'm going through this relatively quickly, but questions about TII. Now's your chance to ask. All right, statement number 3, CFI. This is obviously the more challenging one. And the key to your CFI is you need to basically remember you're doing the same process 4 times. Income statement minus change in balance sheet is cash flow. So we're going to repeat that process for operating, no plat, look at to our free cash flow, for non-operating cash flow, for the debt cash flow, and for the equity cash flow. So we'll start out with the free cash flow. So income statement is our no plat, add back depreciation, gets us the gross cash flow or the cash coming from the income statement. Change in the balance sheet is the change in the invested capital. Now, again, what I gave you last week was the shortcut. And the shortcut said take invested capital for the current year minus the previous year and add current year's depreciation. And that would be your gross investments. What I told you last week as well is I said, well, you can also do it more granularly. You do it line item by line item. This is the more granular approach. So whether you want to be granular or whether you want to use the shortcut for the midterm, I don't care. You can use the shortcut and you'll still get credit, right? I like to do it granularly and the shortcut because it makes sure I don't make a mistake. But the point is, what does this really represent? It's the change in the working capital, the CapEx, the change in the goodwill, which is the acquisition premiums, and the change in the other long-term liabilities that we're operating. So you net all those together, you get that gross investment. Okay? And so again, gross cash flow minus gross investment is free cash flow. This is also a reminder of what's different about this class because we're calling this operating working capital as an example. Even though I say it's working capital, it's operating because you can see us on TFI, we used operating cash. We didn't use the total cash. So we can't just say current assets. We actually stripped out the debt. Short-term debt is actually a 3. So it's not a current liability. Okay? And I think practically one of the reasons why McKinsey and M&M did this is the games that CFOs and treasurers play in the real world. So here's the game I can play. If I use a traditional accounting definition of current assets minus current liabilities, then what I can do is I can say short-term debt gets paid off in the next year, so it's not going to be around. So when you calculate my capital structure, if you just look at the long-term debt as part of my capital structure, then what I can do is I can just issue a bunch of 90-day commercial paper, roll it over again and again and again, and actually look like I actually have a cleaner balance sheet than I do. Even though I never intend to pay it off, and I'm just going to roll it over. It's like a person with a credit card that makes minimum payments for the next 5 years. Okay? Oh yeah, I'm going to pay it off at the end of the month, but I never do. That's long-term debt. And this is what I mean by CFOs are starting to game the system because they could basically say, oh, analysts are just looking at my long-term debt, so I'll just use short-term debt and roll it over, and they won't notice. Well, that's why what we're going to say in this class is all debt is long-term, including short-term. That's why we're pulling it out of current liabilities, and we're putting it as a 3. Same thing, commercial paper. We're going to pull commercial paper out of current liabilities. We're going to call it debt, and it's debt. And the only way it's paid off is if we truly believe it's going to be paid off. It's not just going to be an arbitrary classification by the accountants. So that's the point. Current assets minus current liabilities is not our definition of operating working capital. We're stripping out the non-operating assets. We're stripping out the debt liabilities. And we're just looking at a cleaner version of working capital. Okay? That actually was key to what we would have done on TFI. But more importantly, that'll become apparent when you do the granularity of the CFI. But the point is, you get your free cash flow. That's your operating free cash flow. Do the same thing for the non-operating. Non-operating interest income, non-operating after-tax non-operating income. That's the income statement impact. Change in the balance sheet. Change in excess cash, change in equity investments, change in other long-term non-operating liabilities. Net those together. That's your non-operating cash flow. Add the two, get CFI. Again, I didn't show the granularity, but here's the point. It goes back to the signs. So again, I'm going to use another metaphor with you guys that I used with the earlier classes because it's just the way I think about this. But I like to think of CFI as my checking account on a personal level. And that's the account that I pay all my bills with. And then I have a Fidelity savings account, kind of like my retirement savings. So here's the deal. If I take money from my checking and I send it to my Fidelity savings, do I have more or less cash available to pay my current bills? I'll have less cash to pay my current bills. Would everybody agree? Therefore, I have less CFI. So cash flow available to investors, think of its name, is the cash that you have available now to pay those bills. So if you increase your excess cash, send money to savings, you have less available to pay the bills. So when excess cash goes up, what happens to CFI? When excess cash goes up, what happens to CFI? It goes down. The opposite is true. I don't have any money to pay my bills. I raid my savings. I take money out of excess cash. I put it into my checking account to use to pay my bills. The reduction of excess cash actually increases my CFI. So that's why I said last week, there's no hard and fast rule for pluses and minuses. You have to look at the data that's presented and just think about it intuitively, which direction it's moving the cash. So, and the operating and non-operating liabilities, generally, if it's adding income, it's adding to the cash that I have available to investors. If it's an investment in an asset, it's taking away from the cash. And then the third one in there, so equity investments. If I buy a stake in another business, is that going to add or subtract to my CFI? If I spend $345 million buying a stake in another business, does that add or subtract to my CFI? Subtracts, right? And here's the third one. Say you pay rent. So hypothetically, you don't pay your rent this month. Okay, not saying bad things aren't going to happen to you, but say you don't. Guess what? You got more cash, right? Eventually, you're going to have to pay it, but right now you got more cash by skipping your rent. Well, the same is true when companies add more liabilities. So if I can owe you money that I don't pay in the short term, there's more cash available to pay other bills. Not saying it's a great thing, but nonetheless, companies will do it. So an increase in liabilities will actually add to your CFI. Same thing. If I have a bill that's due in 6 months, but I decide I want to pay it today, well, that's going to reduce the cash I have available to pay everybody else. So if I prepay that liability, reduce my liability, then that's going to actually decrease my CFI. So when I thought about those signs, which I added, that's how I got to the signs for change in excess cash. So reductions of excess cash were negative. Changes in equity investments where I bought shares were negative. When I sold shares were positive. And when I didn't pay my bills, increased my liabilities, it added to cash. When I paid my bills, it actually reduced my liabilities, which reduced my CFI. And that got to me my CFI 213.4 and negative 227. I know I threw a lot at you all at once, but questions? Okay. Well, I had 213.4 to pay out. How did I distribute it? Again, income statement impacts, that was my after-tax interest expense. Balance sheet, change in debt. So what this company did is it basically borrowed $160 million of short-term and $400 million of long-term in those 2 years. So when it borrowed more money, that's a negative to the firm, negative flow. But it still paid interest, which was positive back to the investors. Minority interest. These were the dividends paid to the minority shareholders on the minority stake that this company controlled. Those are payments, just like interest payments. It also paid preferred and common dividends to its common shareholders, which leads to trick number 2 on the CFI. So on TII, we rearrange the income statement, which stops at net income. Dividends are not part of the income statement. Right? But when we get to the cash flow statement, net income is not the cash distribution to the shareholders. So in the CFI, the trick is we replace the net income with the dividends. So you don't put net income on the CFI. You put the dividends that were distributed on the CFI. And that's the trick. So the common or preferred. And then it's the change in the minority interest, the change in the preferred stock, or the change in the common stock. So in this case, we had more preferred stock issued, negative 100, but we still paid dividends of 30, positive 30. So essentially, it's a net 70 of issue. Okay? But nonetheless, income statement, change in balance sheet, and then the final one is the distribution of cash to shareholders, which is treasury stock. We distributed $245 million this year, or last year, and $75 million this year. And that would have gotten us to the CFI, the 213.4, and the negative 227. Again, questions? Yes, sir.
So you said minority interest on this one, it didn't change, but normally it would be included in this package.
So if on the balance sheet, so go back to the TFI, if I had actually changed the total amount of minority interest, which I did not here, but will likely do on the midterm exam, then you would actually, just like issuing equity, if I increase my minority interest, that means I'm getting more. So therefore, negative or positive. Yeah, exactly. So essentially that would be again, if I add, just like I add more stock, add more debt, add more minority interest, it's a negative inflow to the firm. If I pay it out, reduce it, it's a positive number on the CFI. Okay. Other questions? Okay, statement number 3, economic profit, also known as economic value added. So, 2 ways to do it. Again, every statement has 2 ways. So I'm going to ask you using the BOY beginning of year method. I'm not going to change that on the midterm. I'm not going to try and trick you. So it will be the beginning of year method on the midterm. And what does that mean? That means you take current year no plat divided by previous year invested capital is beginning of year ROIC. If I had said end of year ROIC, it would be current year no plat divided by current year invested capital. But since I said beginning of year, C2 divided by B3. So this year, based on beginning of year ROIC, I made 4.9%. I'll give you a whack. In this hypothetical, I gave you 6%, which meant I had a negative 1.1 spread. So I was 1.1% in the hole this period, this year, based on what you expected. I only made 4.9, you expected 6. So since I was 1.1% in the hole on 3260 of investment, I destroyed $34.6 million worth of value. That's what economic value added says. It's a 1 period representation that says, during this period of time, I was $34.6 million short of meeting your expectation. I destroyed value. That's my NPV for this 1 period, negative 34.16, using the spread method. Said another way, I made $161 million of after-tax profit, my no plat. I had 3260 tied up that you expected to make 6% on. 6% of 3260 is 195.6. So you expected me, for the risk that I took for this investment, to generate 195.6 of profit. When all the dust settled, I only made 161. I was 34.6 million short of your expectation, given the risk that you had taken. I did not create value during this period of time. That's economic value added / economic profit. That's all it is, right? Just a 1 period view of the firm. It's dangerous, right? It's both clean. What's nice about EVA is it's simplistic, but it's dangerous. The reason it's simplistic is I can look at this firm, I get a snapshot to say, you know what? It's destroying value. Right now, it's not creating value. Very clearly, 1 number, and I can tell you what my gap is, and I can tell you what management needs to do to close that gap. And that's the beauty of EVA. But here's the danger of EVA. In the real world, you know what this is not looking at is the future. And one of the ways that I can improve my performance over time, stop spending money. Let's skip some maintenance on this plant. Let's not hire the people that we need. Let's not invest in the marketing and R&D to replace our product services and help customers in the future. And oh, by the way, let's do a $15 billion. Sorry, Berkshire Hathaway, that you bought us, that we were Kraft Heinz, but we haven't invested anything in our business in the last 5 years, and our business is deteriorating. But we had great EVA for the last 5 years. Because with no investment, we monetized the hell out of this business, and now we're screwed in the marketplace because we got nothing to go. Sorry, Berkshire Hathaway, but I know you like to own business forever, so hopefully you'll figure out a way to fix this one without spending any money. See, that's the danger in the real world of EVA, is that you can actually have a company like Kraft Heinz that looks like they're doing really well until they don't. And management's getting bonuses on creating value. In every period, they're creating value. They're creating value by mortgaging the future to basically monetize the present. And that's the one criticism of EVA and economic profit in the real world. It's not a forward-looking metric. And it's also a criticism of ROIC, because you can do the same thing for ROIC. I can essentially monetize my ROIC by cutting back investments. So this is key to valuation. This is a snapshot of today. It may not be that the firm's destroying value, because this firm might actually be investing now to try and pay off later. So even though they have a negative economic profit, it may or may not be a bad thing. We'll have to make an additional assessment. But nonetheless, it's a snapshot. It's a snapshot that companies use to judge themselves in the real world. Questions? Okay, that's going to be your exam. It's exactly what you have to do for the exam, and it's just a repeat process. What's going to change is the years, the numbers, the columns, but otherwise it's a pretty straightforward process. You'll have to do the 4 tabs. All right, so let's talk about homework 4. So we were disrupted by snow, unfortunately, last week. So we couldn't do homework 4, so we're going to do homework 4 right now. So what is homework 4? Again, I want to thank Bloomberg for coming into class and spending a lot of time to educate us on using the terminal, but homework 4 will involve the terminal. So if we go to Bloomberg, I want to start out with the first part of homework 4. You go to assignments, 2 parts. Part 1 is we have to create operating ROIC in Bloomberg, which doesn't exist in Bloomberg. So that means we have to create a custom field or a series of custom fields to build an operating ROIC. And one of the nice features of the Bloomberg terminal is, in addition to all their standard fields, by your personal account, you can have personalized fields and personalized formulas in their database that are tied to you. And sitting side by side with their normal fields, you can search and use these to do things. So that's a cool feature of Bloomberg. So that's what we're going to do. We're going to create the concept of operating ROIC in every one of your accounts. These are the formulas to do so. Okay? Now, here's where you can do it. In Bloomberg, you can create a custom formula in one of 2 sections, either EQS or RV. Those are the only 2 places in Bloomberg that you can create a custom formula. You are not allowed to create custom formulas in FA. I asked Bloomberg again about this when they were here on Monday. They still said we don't let you do it in FA. It's a frustration that a lot of people have. But unfortunately, you can't do it with historical data. You can only do it with comparative data or the equity screening tool. So I'm going to recommend you actually do this in the RV section. So go to RV, but you can do this in EQS. What you'll then do is you'll go to your custom tab, and there's this little gear icon. And with this little gear icon, if you click on it, you can add a formula, and that will bring you to the custom formula creation screen. Okay? You can get to the same screen in EQS when you add a custom formula. Over on the left are the custom fields that you would have created. Now for you, it's probably blank, but I've been using Bloomberg for a while, so I have a bunch of my own custom fields. Okay? And we're going to try and build to operating ROIC through a number of custom fields. So this middle block is where you basically type in your code for your custom fields. But you're probably not going to know the Bloomberg names of every one of their database fields, so they give you this option above to search for things that will basically type in the code, the database name. So we want to calculate no plat. So that's going to be our first custom field. So to calculate no plat, we go into field and we don't use EBIT. Okay? So if you were here on Monday, I'd actually ask my former TA to basically do a quick no plat of EBIT times 1 minus the effective tax rate, right? But that was actually done incorrectly, intentionally, because EBIT is not the number we want to use for no plat. Why? So if you did it, wipe it out. You screwed up. EBIT includes,
Not operating.
exactly. So the one problem is in the real world, unlike on the exam that I'm going to give you and the homework I give you, accountants could put non-operating items above EBIT. So we don't want to use EBIT when we calculate our no plat. So here's how you actually need to do it. Bloomberg actually has a field called operating income, where they are taking out the non-operating items. And that's the one I want you to start with. Operating income or loss. It could actually be identical to EBIT if you don't have any non-operating items, or it may not be identical to your EBIT if you have non-operating items, but this is the one where they've adjusted out the non-operating items. So we want to start with that one. Select that. Then it says, which one do you want? The one we want is latest year. Because what I also confirmed on Monday is if you do latest filing, that's a quarterly number. We want an annual number. So we want latest year. Okay? So click on latest year and then hit enter. Boom. $IS033:Y. So if you're a Bloomberg jock and you really know the terminal, you wouldn't have to do that. You just put in string ISS033:Y and you're off to the races. Okay? But if you're a human like me, you don't know that stuff. So you just type in operating income and it puts that formula in there. By the way, what do you think :Y means? What's the Y after the colon? Current year. So that's the last reported year. What do you think last year's, 2017, would be? Y minus 1. What do you think 2020 estimate would be? Y plus 1. So that's the point. You start learning Bloomberg, you can actually start modifying your formulas pretty easily. But right now, I want you to do last reported year. So you will do, so we all do the same one, that. Then what we're going to do is we're going to multiply that by left paren, 1 minus, and then same thing, field, the effective tax rate. But I want the effective tax rate based on the year, not the quarter, so latest year, all consistent. Enter, boom, it's there. So $RR037:Y. Stop Microsoft. Close my paren. And then you either hit save or save and use. Either way, it'll ask you to name it. I'm going to do save and use. And then you name it. So this is my no plat 101 test. You can use up to 11 characters in a name. You guys should call it no plat. I already have my no plat in there. I don't want to screw with it. If you already have it, it'll ask you if you want to rewrite it. So you name it, and if you did save and use, it'll put it on this template. Okay, so Starbucks no plat in section 101 is 80.9 billion negative. Well, that number looks kind of effed up, doesn't it? All right, let's be a little granular here. So let's take our operating income or loss.
How do you get back to that formula you just had? Like I just switched to equity.
So hold on a second. Take operating income or loss for the latest year. Boom, I'll put it on my template. That was 4.46 billion. If I click here and go to add formula, it'll bring me to the list. If I click on it, it'll give me that formula. But here's the point. Starbucks operating income last year was 4.46 billion. How did we get a no plat of negative 81 billion? That looks screwed up. I did everything Professor Perfetti said, almost. By the way, what is my effective tax rate? My effective tax rate last year is 17.01%. So how does 4.46 times 1 minus 17.01 get to negative 80.9? And I'll give you a hint. Because this field is 17.01. It's not 0.701. So even though this says 17.01%, in their database, the tax rate, the number is 17.01. So that's why if you're like, oh, why did he put a divide by 100? That's why. Because, and this is the danger of any database system, including Bloomberg, but you do the same thing with FactSet and others, is that you got to see what you're actually dealing with. So that's why I like to do this in the RV screen, because I like to test my numbers to make sure that Bloomberg didn't screw me in some way, because they don't know you're putting together a custom field, and they just gave you an effective tax rate, which was correct, but they listed as 17. And when I subtract 1 minus 17, well, that's not the same as subtracting 1 minus 0.17. So I need to know that the number comes in as 17, not 0.17. And typically, until I know their system, I like to basically put the fields that I'm putting in there to see what those values are. So in the first class, some people were trying to do the template, and they're like, my numbers don't make any sense, help. And so this is the process I'd recommend. Like, as you're building these, put them in there, make it pass the smell test. Does this look right? And this is how you'd have quickly seen you have this really weird looking no plat. Okay, so basically formulas on formulas. Once you take no plat, then you do operating cash, which is 2% of revenue, last year's revenue. Okay, then for operating working capital, it's that operating cash plus receivables plus inventory plus other current assets minus payables minus other short-term liabilities. So again, this is not current assets minus current liabilities. Okay, then what's operating invested capital? It's that working capital plus PP&E plus goodwill. What's ROIC? That no plat divided by that operating invested capital times 100, because it's going to come out with a number like 0.12, and you want to display 12% to be consistent with the WACC that you're going to see when we do spreads. So we're going to multiply it by 100. And then you're basically going to do, for Starbucks, this is how you're going to be graded. So you're going to go to Starbucks, and then you're going to basically, once you create those custom fields, you're going to create a blank template, and you're going to go for BICS algorithm, restaurants, country of domicile. You're going to type in your custom field of operating ROIC, which, by the way, you'll see where it says custom field. Those are the ones you create. These are the standard Bloomberg one. They'll be mixed. Take your operating ROIC, hit enter, boom. Take your WACC, hit enter, boom, and that's what you're going to submit. You're going to submit the screenshot. But here's what's important. When you submit the screenshot, 37.08. That's the number you need for your operating ROIC for Starbucks. If you don't have 37.08, you get a 0. If you do have 37.08, you'll get a 1. But you have to have the screenshot. You got to get 38.59 and 37.08, and you got to get those two numbers, because those are what are going to be graded by the TAs on this assignment. So there's your hint. And this is being recorded on video, by the way. Yes, sir.
So do you not want a screenshot with, like, you don't need the no flag?
Nope. Because the only way that you're going to get the right no plat and the other things is to get the 3708. You would have had to get all this right.
Okay, so you just need the.
I need the 3708.
Okay.
So, but here's why this is important. From this class forward, whenever I ask you to do an EIC, you're using this operating ROIC. And we're going to all be looking at the same data consistently for the rest of the semester. So that's why you're like, this is going to be ticky-tack. How could I do all this work? I get 37.19 and he's giving me 0 credit. Is because in order to do all the assignments for the rest of the semester, I need to make sure that you have a correct, clean operating ROIC. And I don't want to have dirty ROICs. So we all have to be doing it in the same way. Okay, so that's the only way we're going to have consistency going forward. So we're building this reusable operating ROIC that is very representative of an operating ROIC in the real world. So I need you to do it right. So that's what this part of the assignment is getting that right. But the nice thing is, once it's in your database, the next time you do an EIC, you got a save field template, you're done. And you got the operating ROIC for the industry. Right? And by the way, that is not, if I type in ROIC for the latest year, the same as the Bloomberg ROIC, which for Starbucks would have been 20.22%. This is what they make when they sell coffee. This includes the non-operating assets. Big difference between the two. It's going to matter when we do our valuation. Okay, but you don't put this in your assignment. This is the assignment. That's the first half of the assignment. Questions about that? All right, second one. Second half of the assignment. After you do the midterm, to me, the exciting part of the semester is now we start getting into the valuation. we're going to spend 3 weeks after the midterm, spring break in the middle, but basically building a very detailed Excel valuation model. Okay? I'll give you a hint. What company do you think we're going to do this semester? Starbucks. So, in order to do Starbucks, we need their data to do the valuation. I'll give you a preview. Last semester, we built a valuation model on a company called Parker Hannifin. And this was the final model we built. But in the first tab of the model, we have this tab called Model Data, which is just 80 odd rows of revenue, cost of revenue, gross profit, other revenue, fields coming from Bloomberg. All right? And here's why this is important. One of the questions I had asked Bloomberg when they were here again last week is about their standardized income statement, which is, if you go to FA, they have a template which is standardized. They call it the adjusted statement, but it's supposed to be standardized. But what they admitted, again on Monday, is that in the S&P 500, they have 5 of these. So they have 5 standardized templates depending on the type of company you are in the S&P 500. And oh, by the way, within those 5 templates, they have further adjustments they make to individual companies in their standardized template. What? WTF. So that becomes a problem if I'm trying to build a reusable model. I need the standardized template to be standardized the same way every single time. And since Bloomberg doesn't do this, and Bloomberg doesn't give us a mapping to all of their standardized statements, they won't give you one, then the only way that we can do this is we're going to have to create our own. So what I've been trying to do over the last several years is piece together across their 5 templates all the fields that they're using. And that is this tab. It's not a complete tab because what we're finding, sometimes a lot of new fields to the standardized template, and then we got to figure out what it is and how to add it. Okay? And that will happen to one of your teams later this semester. Happened to a team last semester. Okay? Because they basically like, my model doesn't balance. Well, Bloomberg added something that was to their standardized template. You got to go figure out what they added. Okay? So the point is, 99% of the time, it's not going to matter. But every year that 1% really sucks. But here's the point. We're building this cumulative list. So it will take us 3 weeks to build a valuation model on these standardized fields. Because what I'm going to do with you is we're going to create our own standardized income statement that works across the entire S&P 500. Actually, probably the Global 1000. So if you were to do Unilever, it would work just as well as if you did Starbucks. So here's the point. We're going to create a standardized income statement balance sheet. But to do that, I need to make sure that cost of revenue always is on row 7. Because if it's on row 8 or row 6, my model's going to break. So 3 weeks to create the first company, 5 minutes to work on the second company, 4 minutes to do company number 3. Like the beauty of what we're going to do is we're going to build a model that literally will do valuations in near real time, but we got to make sure it's replicable. So in order to do this, every one of you, 160 across all the sections, have to have this template with these fields in this order in Bloomberg, not any different order. Because if you have gross profit before cost of revenue, it'll break the model. So here's what you have to do. You have to go to FA. You might as well start on Starbucks, but you can do on Parker Hannifin if you want. Custom. Create a custom template. See where it says enter field? That's where you type in the field name. Now they have a non-recommended way to do it and the recommended way to do it. So you're going to have to basically do this process 80 times. Revenue. You type in revenue, and here's the danger. Bloomberg has a lot of fields called revenue. Is it revenue? Is it sales and services revenue? Is it net revenue? Is it which revenue, net adjusted revenue? Like which revenue is the revenue that Professor Perfetti is using in the standardized template? I don't know. That's a problem. So this is what matters. I call these the friendly names. And the problem with Bloomberg's friendly names, there's a lot of them. And they look very similar. And worse, they change them from time to time. And they're different across companies. So European companies call sales turnover, but US companies call sales, and sometimes revenue. And it just depends on whatever the Bloomberg analysts happen to type in. But the one thing Bloomberg never changes is there's a hidden column B. And if you unhide it, the hidden column B, this is the database name. No matter what they call it, sales underscore rev underscore term. So the easier way to do the assignment, and the way I recommend, is you take sales underscore rev underscore term, copy it, you go to Bloomberg, paste it. It's the very first one, enter, done. And if you hover over it, you'll see Excel field sales underscore rev underscore term. Then cost of revenue, copy, paste, select. Gross profit. That one's actually friendly. Copy, paste, select. Just repeat. Just get it right. And here's the way it's going to be graded. I'm going to tell the TAs to do something like go to row 46. And for you, it needs to be long-term debt. And I'll say check 2014. So 2014 long-term debt has to be 1508.1. If it is, you get 1 point. If it isn't, you get a 0. And again, these two assignments are going to be harshly graded because I need exact templates. And here's why. Because coming up in a few weeks, the assignment's going to be, all right, value Dunkin' Donuts. You got 5 minutes. Get it done. Right? The only way you're going to be able to do that is if you can go to your model, get to this template, and you have it ready to go correctly. Okay? So that's what I'm saying. This is a very, as much as it sounds like a rote exercise, this is very important stepping stone for where we're going else later in the semester. So I need everybody to have an operating ROIC, and I need everybody to have a template. By the way, when you finish the template, what you'll want to do is click on the Save button. You want to name it something. I called mine Model, so I know what it is. And then when you save it, it'll be up here in your list of saved templates. I have a bunch of saved templates. But nonetheless, here's Starbucks. I go to my model template. That's the solution. Then here's how you're going to turn it in. Export to Excel the current template. By the way, in column B, they always, I don't know why, but they hide the Bloomberg fields. They're there. They're just hidden in column B. So you'll need to unhide them to do this assignment. All right. And then the last thing, when you export, you need to make sure you're exporting 6 periods, because the model that we're building will use six years of data, and annual data. And finally, these little dashes, when Bloomberg is missing information, it puts a dash in there. Excel chokes on dashes. It just does not do well with dashes and formulas. Can't reference a dash. It just gives you an error. So, final step, get rid of the dashes. Take the dash, copy the dash, find the dash, replace the dash with zeros, replace all. You will replace 27 dashes with zeros. Now you do it manually, I don't know why, but find and replace is the easy way to do it. By the way, make sure you copy the long dash, because if you just do a short dash, which is a negative, it'll take all your negative numbers and turn them into zeros, which is bad. Okay, because this is a long dash, it's like a double dash. It's not a minus. So copy their long dash. Okay, and that's what you need to turn in for Friday, 5 p.m. Eastern. Okay, so you need an operating ROIC, and again, give me the spread template for Starbucks based on that industry, and you have to do this template for Starbucks with 6 years worth of data, basically with no dashes, with zeros. You'll turn this in, individual assignment, due Friday. Midterm is on Monday. You can take that wherever during your 90-minute period of time. And again, our next lecture will be next Wednesday. We start on the actual valuation model before spring break. So that's what's coming up. Final questions? Okay, see everybody next Wednesday. What's today? February 27th. Yes.
How did you export it to the Excel document?
So in Bloomberg, hold on one second.